Hey, I'm Ben from Modern Graham, and today we are going to talk about the Goldman Sachs Group and do a Modern Graham valuation, so be sure to stick around to see what I think of this company. Now, Goldman Sachs, the ticker is GS. The current price is 366.78. It is a financial services company, and it is in the capital markets industry. These are the items from the balance sheet that I find the most important: total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and shares outstanding. All of these figures will come into play during this valuation. Now, if you go over here and look at this chart, you can see the history of the earnings over the last, what is this? No, just over 20 years. Earnings went up and then they crashed during the right before the financial crisis, actually. And then they've kind of been up and down for a ways, and lately they've been through the roof again. Now, dividends per share have been kind of on the same trajectory, but they have been a little bit more steady. So that is something to pay attention to. Here's the details over here, and we have, like I said, 23 years of earnings history to look at. Earnings, you can see they went up, they skyrocketed, and then the Great Recession hit and they fell down. Then they've been kind of up and down a little bit, and lately they've been through the roof. EPS MG is a normalized weighted average of the earnings per share, and I normalize that so that we can try to smooth out some of those big changes in the business cycle. And so you can see the hit on the Great Recession was not as big on the weighted average than it was in real, or like in the everyday earnings per share, the regular one. But you can see that that has grown considerably, and this year it is estimated to be at the highest point yet. Now, dividends, you can see the history here as well. Dividends have gone up, and they have been pretty steady. There were a few years, again, that they did not grow. Interestingly, in the Great Recession, when the earnings took a huge hit, they didn't drop the dividend. They just didn't grow it, which is a very interesting point there. Now, they did drop it a couple years later in 2010, and then they kept it flat for a little bit, and since then it has been growing again. So that is good to see. Dividend payout ratio has been relatively low for Goldman Sachs. And that is a little bit interesting because, I mean, they have been clearly growing their earnings. You would think that they would be growing the dividend a little bit more than they have been, although 20 to 30% growth the last few years is considerable there. Stage one of the analysis, we need to look to see if this company is suitable for the defensive investor or the enterprising investor. And remember, the defensive investor is one who is not willing to take more time to do further research, so they have stringent requirements for companies that they will even consider to invest in. The defensive investor requires that a company pass SIPs out of the following 7 tests. Number 1, the market cap has to be over $2 billion. Well, this one easily passes that at $123 billion for the market cap. So this one is definitely over 2. Current ratio is supposed to be over 2. It fails in that regard. This one, it is only 1.34. Positive earnings per share for 10 straight years. Well, it passes that. Dividend payments for 10 straight years, it passes that as well. Increase of 33% in earnings per share in the last 10 years. So we look at that, and we have a growth of 125% over that 10-year period. So it is better than that 33% requirement. PEMG, the price to earnings Modern Graham ratio, that's price over the weighted average. It has to be less than 20, and it is in this case at 9.97. Then the price to book ratio, which is the price divided by the book value, is 1.15, which is less than the requirement of 2.5. So we pass that. And so we, if you've been counting score, are at 6 points out of the 7, and we are suitable for the defensive investor. The enterprising investor must pass 4 out of the following 5 tests or be suitable for the defensive investor. Remember, the enterprising investor is somebody who is willing to do further research, so they don't have as stringent requirements as the defensive investor, but if it already meets the ones for the defensive investor, then it would be suitable for the enterprising investor as well. Just in this case, we have a fail on current ratio and a fail on debt to net current assets. So it has two fails, and if it wasn't suitable for the defensive investor, it wouldn't be suitable for the enterprising investor, but it is in this case, so we can move on. Stage 2, we wanted to determine the intrinsic value, and to do that, we look at the modern Graham value formula, which is taken from Benjamin Graham's The Intelligent Investor classic textbook, or I guess it's not a textbook, it's just a regular book about investing, but it is the book about investing. Anyway, so the value, or the formula is value equals earnings per share modern Graham. That's the take that I have on it. I use my weighted average here, times 8.5 plus 2 times the growth rate. So we have two variables to figure out: earnings per share modern Graham and growth. Earnings per share modern Graham, again, is a weighted average. We look at the last 5 years. We put the most weight on the current year and the least weight on the oldest figure. We get 36.79, so we put that in over here. And the growth rate, we want to look at the current earnings per share, and that from 5 years ago, we get a total growth of 118%. Divide that by 5, and you get an average growth of 23.69. Now, we have two safety margins going on here. One, we have a safety margin where we reduce it a little bit because growth is such a key figure in this variable, or this formula, that we don't want to overestimate growth or we will have an issue. Then we also have a thing where I cap it at 15%. So normally the formula that I use would result in a growth estimate of 17.77%. But I don't think any company can be expected to grow more than 15% in perpetuity. And arguably, this may still be too high. It may still be too high to estimate that growth for a company can be at 15%. But that is the limit I put on here. And so we're going with 15% here. The value that we end up with, this is not the right thing here. We want this to be 13. Okay, so the value we end up with is 1,416, and the price is way below that at 366. So we're trading at 25% of its intrinsic value, and I believe it is undervalued because of that. Now, you also have a couple other ways to look at this. If you put just a 3% growth rate in there, then your value comes out to $533, which is still more than the current price. If you put a 0% growth rate, you get a value of $312. So if the company doesn't grow any more for the rest of time, it would be worth $312. Currently, the market is implying a growth rate of 0.73%. And you can look at that and say, okay, well, I think it is going to grow more than that over time. So I think it is therefore undervalued. Or I think it's not going to grow 0.373%. So it is therefore overvalued. That's one way of using that market implied growth rate. Moving down here, we look at the modern Graham grade. It gets 2 points for the investor's suitability, 1 point for good price to value, 1 point for trading below its Graham number, which we'll talk about more in a moment, 0 points for long-term dividend growth, half a point for having a dividend yield over 2%, half a point for being trading at the PE ratio below its industry average, and it's not trading below its NCAV, but overall it gets 5 points, which on our graph here, or chart, it comes to a grade of A. Stage 3, further research. So if at this point you've figured out that it is suitable for your investor type and that it is undervalued, the next step would be to do further research to determine if it is suitable for your individual portfolio. I can't tell you that. I can't tell you if it's a good thing to buy or not, if it's just, that is a step that you have to take yourself. And to do that, we can look at the net current asset value formula. This one, it doesn't apply here because the NCAV is negative, but that would be a liquidation value. So on some companies that may be severely distressed in price, then current assets minus total liabilities divided by the shares outstanding would give you the amount available for shareholders if they took their cash and paid off all of their liabilities. That would be what's left. And here it's negative, so that doesn't apply. But Graham number formula, this is another figure that many people use to determine the value of a company. And it's based on some of those requirements for the defensive investor. So here we end up with a Graham number of 498.57, which is way above its current price. So keep that in mind too. PEMG, as I mentioned, is the price divided by the earnings per share, and the PEMG here is 9.97. That is using the weighted average for earnings that I use. Current ratio is 1.34, PB ratio is 1.15, dividend yield is 2.32%, and it has had 11 consecutive years of dividend growth. Now, stage 4 of the process is to look at the market. And if you've decided that the company is undervalued, suitable for your investor type, and a good fit for your individual portfolio, the next step would be to try to time the purchase right, because you want to maximize your profit. It's one thing to buy a company that is undervalued. It's a whole nother level to buy a company that's undervalued and about to be on its way up further. Now, Goldman Sachs, if we go back a little bit to November of last year, it started to go down, and you can see a trend line developed where it kept coming up and getting around that line and coming back down. And so it couldn't quite break through that, but it did that. It broke through in July, and then it came back up. It came down and it hit this support level at 278. Then it broke through that trend line, and it came all the way back up to this resistance level here, which had been set a little bit here and a little bit in this area, but really it was a support level back here in June of last year. And March of last year, it was a level there. So it became a level again here, and it struggled at that point, and then it came through and it hit that, and it couldn't quite break through. It came back down and it tested it again, and then it came back down, and it came all the way down to here, and it bounced back up, and then it formed what looks to be a little bit of a two bottoms, a double bottom. And when it does that, it was expected that it would break through on the way back up, and that's what it did. And now it would appear that it is heading to this level here. But if you look at the RSI down here, this shows whether it's oversold or undersold, and we're overbought or undersold. There we go. This one is currently overbought. I would anticipate that it's going to lose momentum and come back down. And when it does that, I will be very interested to see what happens when it comes back down to this about 350 level. If it comes back and bounces again, then I would anticipate that it will break through on its way up. It seems to be on an upward trajectory. If it comes back down through there, then it may come all the way back down. And so that would be what I'm watching for, to see what happens when it comes back to test this 350 mark. And then that will be an opportunity. So that is it for today. Thanks for watching, and I'll catch you next time. Take care.